Hello, everyone. Hopefully you can hear me okay. Got Jessica, Christy, and Riley all here. Just let me know through the chat box or just you can speak in a microphone, whatever you want. Just let me know you can hear me. I just want to double check that you can. It looks like it's working from my side. Okay, excellent. Thank you for letting me know. Alrighty, so this is our last WebEx. So tonight I just wanted to cover chapters 11 and 12. Those are what are due for next week, a week from tonight, on the 17th. So I know some people have already worked ahead and gotten them done, which is great. That's perfectly okay. I got everything out there for you. But for everybody else who's going more week by week, I want to make sure I give you plenty of time to kind of chew over the answers and the questions and make sure you've got a good handle on how to do these kinds of problems. So chapter 11, if you remember the topic, it's about cash flow estimation and risk. And so chapter 11 is really about how do you kind of go through the process of figuring out what the cash flows are for a project. So part of that is, how certain you are with the numbers, what are some of the issues that might arise as you go about to do your calculations to figure out what your cash flow should be and so on. So lots of little things that we have to kind of worry about and think about when we go through that process. And we'll talk about those today. And it still uses some of the same concepts we used last week will come into play too again. So I just kind of want to remind you of that too. So I really didn't get any major questions at all from last week, so it seemed like everybody had a pretty good handle on the material that we covered for chapter 10. So question 11.1 will be the first one that we'll take a look at. And this Excel file that I'm using, it's available under handouts. And then once this WebEx is over, I'll make it available that everybody can see the answers also. But I did put this under handouts in week 7. So this exact file that I'm looking at is right there. So for this one, it says Talbot Industries is considering launching a new product. The new manufacturing equipment will cost $17 million, and production and sales will require an initial $5 million investment in net operating working capital. The company's tax rate is 25%. So the question then is, what is the initial investment outlay? And then we kind of pose some questions based on that. So part A is just to figure out what the initial outlay is, and then kind of go from there. And so this also kind of helps us talk a little bit about the new tax law. So it's called the TCJA, the Tax Cut Jobs Act, was signed into law back in December of 17, and then 2018 was the first full year of the law, and 2019 will be the second full year of the new law. And it changed a little bit with how companies can take depreciation. So one of the goals of the law was to allow companies to do big depreciation on investments. So basically to try to spur investment in property, plant, and equipment, and then be able to take kind of a depreciation hit for that right away. So they mentioned the tax rate, and the reason I'm bringing that up is they're mentioning the tax rate at 25%, and we actually don't need it because of the new tax law. They're kind of just trying to catch us on that one just a little bit. So it's really a pretty simple calculation. This is really easy. I'm sure everybody could do this one. It just says here the new equipment's worth $17 million. So my initial cash outflow would be $17 million. And then also that require a $5 million investment in net operating working capital. And remember what net operating working capital is. It's your current asset minus your current liability. But when I subtract the current liability, I only include accounts payable and accruals. I don't include any short-term debt like notes payable in that. I just include current assets, which is mostly receivables and inventory, and I subtract basically my short-term accounts payable and my accruals. And so that number is 5 million. And that's pretty common if you're going to launch a new product line. What you spend money on is not only just the equipment to make the product, you have to purchase inventory and things like that. So they're saying that net operating working capital will go up by $5 million, essentially probably most of that would be raw material inventory to support the production. And that's it. That's the answer right there. We don't need the 25% at this point. We don't really need it at all for this problem because of the new tax law and the way that works. So that's kind of just giving us that info as a way to throw us off the scent a little bit. Okay, so that was pretty simple, part A. Part B is just kind of some what ifs now. For part B, it says the company spent and expensed $150,000 on research related to the new product last year. What is the initial investment outlay? So basically what they're trying to figure out is, should we change that, yes or no? Basically, I put down yes or no right there to say, do I change my initial outlay of 22 million because of the 150? And the answer would be a no. So I'll just kind of highlight that there just to show you that that should be a no. So the answer is no. And the reason for that is a term for that is called a sunk cost. And a sunk cost is not what they call an incremental cash flow. So when we talk about new cash flows, we're talking about what is incremental. And incremental just simply means change. What will be different based on the existing situation. And this is a brand new product line. So what is incremental is the investment in the $17 million worth of equipment and the $5 million net operating working capital. That is incremental. That will add to new cash that we're going to spend. But a year ago, I spent $150,000 doing some market research or market studies so that I could determine if this product even made sense to launch, right? We should not spend $22 million on a new product unless we believe that product will be successful, that there's a market for it, it makes sense to make it, and so on, right? You wouldn't just do that on a whim, obviously. We all know that. So we spent $150 a year ago just to kind of answer that question, should we do this, yes or no? And obviously the answer is yes, we should do this because they did it. But that would not change my existing cash outlay for what I'm doing. Basically, that was kind of a yes or no, should I do this proposition? And the answer was yes, but I don't include that 150 in the cash outlay. Okay, and then part C says, rather than build a new manufacturing facility, they plan to install the equipment in a building it owns but it's not using. The building could be sold for $1.5 million after tax and real estate commission. Should we basically do something with that? And that's really the question here. And this actually changes it just a little bit. Now, keep in mind, we have to keep in mind what the term opportunity cost is, and that'll come up in your studies. Opportunity cost is I charge myself for opportunities I could have taken but didn't, which is really an odd concept. In accounting, you would never do that. There's no journal entry for opportunity cost, right? There's no opportunity cost expense. But in finance, I do that because I'm trying to get down to cash flow. And so in finance, what I'm saying is, the way the base situation is written is I'm going to put this into a brand new production facility, a new building I'm going to build. Okay. And they're saying, well, what if it was actually that we just have an empty building? And the two choices we have are that we could lease that building or sell it. In this example, they're selling it. Or I could buy this equipment, buy the raw material, and make a new product. It's one or the other, right? I can't do both, obviously. So what they're saying is if I do go down the path of I'm going to fill this empty building with manufacturing equipment and begin to make this new product line, I should charge myself the opportunity cost of I gave up $1.5 million. Now, so basically it says that's 1.5 million after tax and real estate commissions. That's the net number that I'm giving up. So yes, I actually should charge that to myself. So the answer for part C is I would charge myself $1.5 million to the project. That would be a charge to the project. So I take that initial cash outlay and increase that by the 1.5 million. In part C, if that was the scenario, my cash outlay would be the sum of 22 plus 1.5. Okay, so there will be information in your chapter. There will be questions in MindTap about opportunity cost and sunk cost. That's kind of what the point of this particular question was about. to help us figure those out. So the next one is question 2. And it says here, for financial staff of Cairn Communications has identified the following information for the first year rollout of a new proposed service. So we expect some sales, operating cost, depreciation, and then interest expense also on that. So you can see here my sales minus operating cost, depreciation, interest expense. It does mention the tax rate here. They want us to figure out then what is the project's cash flow for the first year. So basically, after year 0 is obviously the year of a big investment typically. And they're saying, let's figure out what the cash flow is for year 1. So I kind of built the format already down here. So my operating cash flow, it kind of looks like a mini income statement, but remember, I'm trying to get down to a cash number. So obviously my sales revenue is the $18 million that they gave us. And then they split out operating costs from depreciation. They're 2 different numbers. So I'm going to put those numbers in. And this is my operating income before tax. So my revenue minus my 2 expenses is $5 million. My tax is 25%. That's the number they gave us right here. So that's $1,250,000. So my net operating income after tax is $3,750,000. Now, the key about depreciation, the key thing to remember is depreciation is a non-cash expense. We don't need to know journal entries for this class, but if you remember journal entries for depreciation, you debit depreciation expense and you credit accumulated depreciation as the 2. So it's an expense that reduces net income, but there was no cash that was spent for it. So the reason I want to include it up here is because I want to decrease my revenue by the amount of depreciation because that lowers my tax number. And depreciation is a tax deductible expense. If I have depreciation, that reduces my tax bill. So my operating income after tax at $3,750,000, I need to add back the depreciation, that non-cash expense, and that gives me what my cash flow will be, $7,750,000. So my year 1, T1, cash flow is $7,750,000. Okay, but that's kind of the format we walk through when we do that. And you'll have a few questions in MindTap that will deal with that. Okay, the next one is salvage value, and basically trying to figure out if we dispose of an asset, what's the cash left over if we dispose of an asset? Because sometimes if you're replacing an asset, whatever you receive for that disposal helps you offset the cost of buying a new asset, whatever the asset is, or you're trading it in or selling old and putting it down to buy new. That's what we're trying to figure out. So it says here that Allen Airlines must liquidate some equipment that's being replaced. This equipment originally cost $12 million, and 75% of that has been depreciated. The federal plus state tax is 25%. What is the equipment's after-tax net salvage value? So it's really, again, a fairly straightforward calculation, and let's go ahead and solve for that. So the original cost is $12 million. And then it just calculates depreciation because I made a formula B there, but 75% of that. So 75% has been depreciated away. That means that the book value is $3 million. So kind of think about the sales price. It says this, and what I forgot to mention with this question, it's kind of a bad question because the question never actually states what the sales price is. That's what I wrote right here. It should have been, the sales price is $4 million, not given in the question, but it should have been. So this is just a copy and paste from the back of the book. So it's just a question that omitted one really important fact. So I'm still going to use it as an example because you have questions like this in MindTap, but my answer sheet shows what the sales price is, which obviously you don't have. And so I hid some rows in this. I'm just going to unhide those rows right here. That kind of left some of the information in that. So the gain on sale, which you would never be able to know without me telling you the sales price is $4 million, is $1 million. Okay, so the gain on sale is the sales price minus the book value. That's $1 million. So if you know anything a little bit about the tax code, when a business has a capital gain, it has to pay a tax on that. And so we mentioned that the federal plus state tax is 25%. And so this company will have $1 million gain on this disposal, and they have to pay a 25% tax on that. So the gain is $1 million, we'll pay a tax of 25%. So the tax is $250. So the net cash after the after-tax salvage value is a $4 million of cash received minus the tax of $250. So the net cash is $3,750,000. So cash received of $1 million, but $1 million of that, $1 million of the $4 million is capital gain. The tax on the capital gain is $250. So I do receive cash of $4 million, but I pay a tax of $250. So my net cash is $3,750,000. Okay. You will for sure have questions about that in your homework. Okay, so the next one then is kind of the next step of replacement, and a new scenario though, but it's going to look pretty similar to what we did last week, some of the same concepts. It says here for Chen Company's milling machine, it says that it's old, it's still relatively good working order, and would last for another 10 years. If they want it to work, it still would work. It is inefficient though compared to modern standards, and so the company is considering replacing it. The new milling machine at a cost of $110,000 delivered and installed would also last for 10 years and would reduce after-tax cash flows, which is a combination of labor savings and some depreciation benefit to reduce our tax bill of $19,000 per year. It'd have a zero salvage value at the end of the life. Project cost of capital is 10, and its marginal tax rate is 25. Should they buy the new machine? Okay, so that's that kind of the what-if game that a lot of companies have to go through, right? Yes, we fully depreciated the old machine, and we can still use something if it's been depreciated. Keep that in mind. There's nothing that says if you depreciate something you have to stop using it or get rid of it. There's no rule about that in any way, shape, or form. So just kind of keep that in mind as an important thing to recall. So we need to kind of run the numbers, right? And this is a very common thing that might be asked of almost anybody in any role at a business. If we buy this new machine for 110, but we figure it'll save us 19,000 per year, should we do this or not, right? Those are kind of some of the things we have to kind of think through and understand. Okay, so with that in mind, let's go ahead and drop in the new number. So they said the cost of capital is 10, so we need to drop that in. And then they said that the initial cash outlay, the negative, at time 0 is 110. And then it's just simply 19,000 a year for 10 years. So I'm just going to type in the 19,000 and do a copy paste. And this looks familiar because we did the exact same thing last week. And that's kind of why I like this chapter. It's really just a continuation of some of the same stuff we learned last week. And we have a positive NPV. So I'm sure everybody remembers if the number is positive, we would generally say, yes, we should do that. So it does make sense for them to buy the new machine, dispose of the old machine, because they'll have a net increase, a net present value of $6,746. So yeah, we should go through and do that. It makes sense. So you crunch the numbers, you run the numbers and decide, does that make sense? Now, of course, the key thing about this particular calculation was the certainty of the 19,000 per year for 10 years. Remember that the longer the term the project, right, the more we have to kind of estimate the future. But I have a feeling that they really understand this machine, this equipment, what they do. I get a sense that they are pretty confident in this number. They should feel pretty good about going ahead and doing this. So that's kind of that replacement. Should we do it? Yes or no? Run the numbers. Yeah, the numbers say we should do it, so we probably should. Okay, we just have one more for chapter 11, then move on to chapter 12. For this one, it's called depreciation methods, and this is just kind of help us visualize and understand the importance of depreciation when it comes to determining what cash flows will be and net present value. And so you will have, this one's a little bit tougher, but I think I'm giving you a really good model to follow right here. And I think that'll help you out when you get some questions kind of like it in your homework. So this is Wendy's boss wants to use straight line depreciation for a new expansion project because he said it will give higher net income in early years and give him a larger bonus, right? It's all about the bonus. The project will last 4 years and require $1.7 million worth of equipment. The company could use either straight line or the 3-year MACRS accelerated depreciation method. If you don't recall what 3-year MACRS stands for, it's called the Modified Accelerated Cost Recovery System. That's just IRS code or IRS speak for depreciation. And the irony here, though, is that when it says 3-year MACRS, it's really a 4-year deal. So why it is that way? Well, it's the IRS code. Nothing makes sense, right? That's about the only answer I have for you. So under straight line, that's pretty simple. I think a lot of you probably remember straight line. Just basically take the cost of 1.7 million and divide it by 4 years. We get an amount per year. They're telling us right here that for MACRS, then there's appropriate depreciation percentages to use each year. Appendix 11A, and there's a hyperlink. If you're looking at your ebook, there's a hyperlink. You just click on that. It takes you right to the table. It'll pop up for you. But they're giving us the rates, so they're making it pretty simple for us. Cost of capital is 10. The tax rate is 25%. Okay. So basically, the question is, what would be the depreciation expense for each method, and then which one would give us a higher NPV? And we'll talk about letter C also. Okay, so that's kind of the scenario. So it's really a change analysis is what this is. And let me kind of get this all on the screen for you so you can see it. So right here, I put in the two numbers. So I just label these columns, columns 1, 2, 2 minus 1, and the tax rate. So this is straight line, just 1.7 million divided by 4. And then the MACRS is the 1.7 times each of the 4 different percentages. So 0.33, 0.4445, 0.1481, and 0.0741. And the thing about MACRS is it takes a lot of depreciation early, and then it kind of goes to a smaller number. So a lot of depreciation right away, and it goes to a smaller number. And think about why the IRS code is built that way. It's built that way to encourage investment. If companies get a huge tax break because they buy a large piece of equipment, and right away I can depreciate a whole bunch of it, that reduces my tax bill, right? And most companies are all about doing that. If I spend a bunch of money buying this equipment, I get a big tax break right away. Okay, so that's the reason for it, and that spurs the economy, encourages companies to buy equipment, invest, which employs people and so on. So we can all kind of figure out why that is. The difference between those two numbers is what column this column is. So basically, I took 2 and I subtracted column 1. So as you can see, I get some positives in these 2 years, the negatives in the last 2 years. And this last column is just simply the difference times the tax rate, basically my tax savings. So I have 2 tax savings in the early years, and then basically I lose those savings in the late years. But if you recall anything about time value of money, the earlier I get something, the better I am, right? Time value really eats away at a number late, the more years away from time zero that we get. So the further away we get, the way more that time value of money eats away at something. So early on, in years 1 and 2, the time value of money doesn't hit that as quite as bad as years 3 and 4. Okay. So the goal then is just to run the numbers, and I'm running the differences as I computed right here. They told us that the cost of capital is 10, they mentioned that. Now this one's unique, and then at year 0, my initial cost is 0 because it's 1.7 million in either scenario. So I don't really worry about that. I just basically if I could put it, I could put in 1.7 million minus 1.7 million, and that'd be my 0. So there's a 0 there, which is different. It's not what we're used to. But then every year after that is just simply these 4 numbers up here. So we'll start out with 35,402.5, 82,662.5, and then minuses, minus 43,307.5, and minus 74,757.5. And I get to a positive 16,902.26. So what I want you to recognize is that by using the MACRS depreciation and getting those huge deductions in year 1 and 2, those are cash savings, right? I saved that much in cash in those 2 years, big positives. Well, then I kind of lose those savings in later years, but those later years, time value of money kind of eats away at that a little bit. So I end up with a positive, almost $17,000. I would just, this is me running the analysis. If I'm the person here, I forget her name already, Wendy, I would go to my boss and say, we're going to save 17 grand of NPV here if we use Mackers. Okay. Now, of course, think about the boss's perspective, and the boss is thinking, well, I really want us to use straight line because that's less expense, right? Notice the difference between the two expense numbers, right? I have a higher net income under straight line, yes, than under Mackers. Absolutely, I do. But I save cash, and cash is king in finance, right? Cash is king. It's all about the cash. I save cash because I have the higher tax deduction. So I save 35 grand in cash in this example, and that's really what I should be focusing on. So sometimes the downside to bonus programs is sometimes bonus plans give management incentives to make bad decisions. That's really what the point of this particular question was. So that's a bad bonus plan. That should not be how that bonus is computed, or we need to take into account the fact that the preferred method is Mackers or whatever that is. It's a bad bonus plan. They should absolutely 100% use the Mackers depreciation and have that increase in NPV. Kind of just keep in mind the role of finance for any organization is we're trying to make decisions to make the company worth more, right? I want to increase the value of the company. And I want, if that's my goal, which it is in finance, I need to focus on using Mackers, right? That increases the value of my company. I want to use the Mackers method. Okay, so it's 11.5, and that's the answers for that one. So that was a little bit tougher. I kind of gave you some of the, the info here just to, instead of having to watch me do the data entry. But I just want you to see that pattern right there. So again, I'll make the answer sheet available, and you can use that then to help you solve any problem kind of like it when you go ahead and do the work in IntelliPath or in MindTap this week. Okay, so now we'll move on to chapter 12. And chapter 12, then the topic of chapter 12 is valuation, corporate valuation, financial planning. So it's a little bit about forecasting and trying to figure out if our company grows, how do I finance that growth? That's kind of one of the things that we'll have to learn in this particular chapter. There's a formula, which I'll show you here in just a moment. It'll help you to figure that out. Okay, so we have Broussard skateboards. It says sales are expected to increase by 15% from 8 million in 2019 to 9.2 million in 2020. Its assets totaled 5 million at the end of 2019. Okay, so just some information here. They're already at full capacity, and that's a huge thing to see. When you get questions that deal with, it's called the AFN, it's called additional funds needed. So I want you to really pay attention to the questions in MindTap and pay attention. Does the question say we're at full capacity, or does it say we're at 80% or 90% or whatever the number might be? Because that changes the answer. So, but in this one, we are at full capacity. Assets must grow at the same rate as projected sales. At the end of 19, current liabilities are 1.4 million, consisting of 450 of accounts payable, 500,000 of notes payable, 450 of accruals. The after-tax profit margin is forecasted to be 6%, and forecasted payout is 40%. Use the AFN to forecast their additional funds needed for the upcoming year. So this is the formula right here. It's in your book, it's in the PowerPoint, it's all over the place. It's not hard to find, but I want to make sure I help you understand what the formula means. Okay, so A0 divided by S0, that just means assets today divided by sales today. That tells you what they call, it's called, oh God, it just escaped my mind all of a sudden. Just one of those thoughts that flies out of your brain, right? Capital intensity ratio, there it is, it came back to me, your capital intensity ratio. Basically what we're trying to figure out is how many assets does it take to gain a sale? So what's that ratio of assets to sales? That tells you how many assets you have to have on hand to support sales of a given amount. Okay, and then we multiply that by the change in sales, because what we said was whatever that asset to sales ratio is today, we're expecting that to be the same as we grow sales. That's part of what they told us in the question up here. So that's a plus. I then subtract from that my liabilities, and I subtract from that what I call my spontaneous liabilities. And so my spontaneous liabilities are liabilities that change with my level of sales. So if sales go up or down, those spontaneous liabilities naturally go up and down and follow along. Okay, and that would be your accounts payable and your accruals. And I mentioned that earlier. The notes payable is not spontaneous. For a note payable to occur, there's underwriting by a bank, there's signatures to authorize it, and so on. But if I am growing sales and I call my supplier and say, I need more raw material because I'm selling more, as long as my account is settled on a timely basis with my supplier, they're going to say, sure, I'll sell you more. I'd love to sell you more, right? So that's usually how that works. Same thing with accruals. They ebb and flow with the amount of sales. So this L0 is my liabilities today, meaning my accruals and notes and my accounts payable. And then I multiply and compared to sales, and I increase that, multiply that by my change in sales. And then the last part of that is basically the third part of this formula. It says PM, that stands for profit margin. S1 is my sales next year, and 1 minus my payout is what percent of earnings are paid out as dividends. Okay, so PM is profit margin, S1 is sales next year, 1 minus my payout. So this is computing my net increase to retained earnings, is really what that is. And you kind of have to remember some accounting to go, oh yeah. So profit margin, I multiply my 6% margin times my next year's sales. S1 is sales next year. And that gives me my net income. And then from my net income, I subtract dividends that I expect to pay, 1 minus payout. Okay. So basically, I know that if I'm going to grow my business, I need to invest in property, plant, equipment. That's the first part. The second part is, well, some of that financing will just be by the natural ebb and flow of accounts payable and accruals. That'll pay for some of it. The last part is my increase to retained earnings will also pay a part of it. Okay, so that's what that formula is trying to tell me, and that we're working through. So I'm going to unhide some rows that I've hidden away for us here. Let me do that quick. And there we go. And I kind of already have everything in there just for the interest of time. And so I just dropped in the numbers already. So the formula's here, and I tried to put in the amounts kind of right below that to the best that I could. So my assets are 5 million. They told us that right here. And they said that my sales are also 8 million at times 0, which is 2019. My change in sales is 1.2 million, 8 million up to 9.2 million. So my sales go up by 1.2 million. And then I solve for that, I get that number right here, 750,000. So basically what I'm saying is I need to finance 750,000 worth of new equipment if I'm going to grow sales by 1.2 million. Okay. I then subtract from that my spontaneous liabilities, which is the 450 plus the 450, that's my 900, divided by sales. And that formula here is then I multiply that by the change in sales again, 1.2 million. So basically I will have an increase in accruals and accounts payable of 135. That's kind of a sort of financing. And the last piece is what's my net increase to retained earnings, and that is the profit margin of 6% multiplied by next year's sales of 9.2 million multiplied by 1 minus the payout. Okay, so basically I'm keeping 60%. I'm retaining 60% of my net income. I'm paying out 40%. And that net increase then, I just kind of have it all spelled out right here. All the numbers is 331,200. So my increase to retained earnings will help to finance some of the acquisition of new assets. So the net is the sum of the three, plus 750 minus these two. So I need to go out and find financing for $283,800 so I can finance the growth of 1.2 million for the next year. Okay, that's what the AFN is all about. So a lot of the questions in the chapter are kind of based on that. So the next one is projected operating assets. And this one's kind of based on ratios, certain percentages. And it says right here, for this one, Berman and Jacor Corporation current sales and partial balance sheet are shown here. Sales are expected to grow by 10% next year, assuming no change in operations from this year to next year. What are the projected total operating assets? Okay, so what you have to do, and what I did is I kind of hid everything over here, so I'm going to make it so you can see this stuff now. It's right there. So what you had to do is do some ratios. I just kind of want you to see the numbers. So cash to sales. So notice that I did cash to sales, I did account receivable to sales, and then inventory to sales. And I did next net fixed assets, which is 500, also divided by sales, and then projected sales. They said that sales will grow by 10%. So 1 million times 1.1 is their growth. Okay. So what we're saying is when we grow, we're assuming all these ratios will hold true and be the same. So that makes it pretty simple then. You can just see all I did here is I took that cash to sales ratio, multiply that by the new sales number. So cash will go up to be 110. My AR will also grow by 20%. Inventory grows by 20%. And my net fixed assets grow by 50%. And then that's it. So very simple. And so I just add those up, and that's my total operating assets. So basically to do this increase, it just basically, and that's what they said right here, assume no change in operations. So what we're saying is these ratios will hold true from one year to the next. And so that just allows me to go through and do the projection and get the new numbers. Okay. And so the next one's pretty similar, and this is question 3. And I did the same thing. I kind of hid this here. So let me make that come alive again. So really almost the same formula, the same concept here. It says here that Smiley Corporation's current sales and partial balance sheet are shown below. Sales are expected to grow by 10%. And it says, assuming no change in operations from this year to next, what are the projected spontaneous liabilities? This top one asked for assets. This one asked for liabilities. That's really the only difference between the two. So kind of the same thing. I'm saying my AP to sales. So I divide my AP, I divide it by sales. 1,000 divided by 10,000 is 10%. Same thing with accruals. Okay, those numbers were the same. And then I have my projected sales. They told me that sales would grow by 10%. So 10,000 times 1.1, or that 10% growth, is 11,000. And so all my ratios now hold true. So 10% growth in AP, 10% growth in accruals, and the sum of the two is my 2.2. Okay, so the top one asked about assets, this one asked about liabilities, but essentially the same concept. Okay, then we'll do one more, then we'll call it good. So the last one is what they call the self-supporting growth rate. And this one we're trying to figure out by how much can sales grow year over year without us needing to go out and acquire new assets to support that growth. So how much could we grow just naturally without having to do major investments in property, plant, equipment? So Maggie's Muffins Bakery generated $5 million in sales during 2019. Its year-end total of assets were $2.5 million. Also at year-end liabilities were $1 million, with $300,000 notes payable, $500,000 accounts payable, $200,000 of accruals. Looking ahead to 2020, the company estimates that its assets must increase at the same rate as sales. Its spontaneous liabilities will increase at the same rate as sales. Its profit margin will be 7%, and payout will be 80%. How large a sales increase can the company achieve without having to raise funds externally? Basically, what they call the self-supporting growth rate. It's the exact same formula, just we have to use algebra now. That's the only issue with this one. So it might be just a little bit tougher from that standpoint. So I did the algebra for you already. I just didn't think it made any sense for you guys to watch me type in a whole bunch of numbers. So I've already got them in here. And but what I kind of want you to see here is I kind of just started out by saying, what are the facts? What do we know? Well, S0, and that's my attempt at a S0, is 5 million. A0, my assets today are 2.5 million. Current liabilities are 700,000. And I want you to notice what I picked up as my liabilities. I picked up the 500,000 accounts payable and the 200,000 accruals. I ignored the notes payable, so always remember that. So I did not include that in the current liability. So I stated note payable separately by itself right here, and my account payable was 500,000. Okay, so that's, and this is more facts about the case. The accruals right here, the payout, the profit margin was 7, the payout ratio was 80%, and so and also we can kind of figure out a few more things, like assets to sales equals 0.5. And you can kind of figure that out, right? You can kind of look at my sales right here were 5 million, assets were 2.5 million. That kind of helps you figure that number out. My L0 is accounts payable plus accruals divided by S0 is 0.14. Okay, so with that information, that 0.5 and that 0.5 again, which is 5 million divided by 2.5, I can take my original AFN formula right here. So that's the full formula. Okay, and I can plug in some of the data now. So I know that A0 divided by S0 is 0.5. I know that L0 divided by S0 is 0.14. And I know what my profit margin is, 0.07. I know what S1 is, or I can solve for S1, I should say. I know that 1 minus my payout is 1 minus 0.8. Let's begin to simplify that formula all the way down. So if you're a little weak on algebra, this step-by-step process should show you that. So, with the 0.5 minus 0.14, all this kind of stuff, I have to simplify that. I get 0.36 equals 0.14, and so on. But anyway, I ultimately get down to 1.8 million divided by this 3.346, and I divide that, and I get 5,202,312. So remember that sales right now are 5 million. So what we're saying is sales could increase by 202,312 without needing additional funds. Okay, that's the hard way to get down to that number. So yes, algebra is involved sometimes, but I think if when you get a question like this is a really good model to follow that'll help you get there. Okay, so that's the key I want you to remember as we look at this and do this. Okay, and that's it. Any questions from anybody? That should give you plenty of little tips and tricks to help you do this and do it well. Okay, I'm not seeing any questions, so I'll just wrap it up. As always, if you need anything at all from me as we wrap up this last week, just let me know. You're welcome, Christy. And I'll be more than happy to help you. I'm around. It's easy to get a hold of me. I think everybody knows that. But if you need anything, just let me know. I'd be happy to help you out. But we're almost done. And once we're done with the homework, you have Christmas break, right? So that's the good news. So once you get done with this, so I would just say power through it, try to get it done, then you have a longer break. That's one way to look at it, right? The quicker I get this done, the longer my break lasts. So if you want a longer break, I would say just get this done and then you get a longer break. And some people I know are wrapping up. This is their last class too. So congrats to those that are finishing up. That's a big deal. Okay, thanks again. I'll send out an email with with this link to the recording and all that good stuff later on. Thanks.